And this was this 67, The Art of SPAC Arbitrage. So if you guys haven't seen the podcast, definitely check out the Absolute Return. And you could also find that in the description. Let's get into some of the things that I really like and wanted to talk about here, guys. So Julian, and maybe you can help us here. So one of the biggest things that I think is first, what is a SPAC and how do they work?
Yeah, it's a great question. And SPACs have really exploded in popularity in 2020. And definitely the trend continues into 2021. Just a massive flood of issuance. I believe as of today, there are around 305 SPAC trading on US markets. So a big new asset class, over $128 billion in market capitalization as of today. But basically how a SPAC works is they do an initial public offering, an IPO, typically $10 per unit. And notice that I said unit, not shares, because they tend to IPO as a combination of shares and warrants combined into one unit. So one unit at $10, typically you get one share and around a third, sometimes half of a warrant. Some come with no warrants. Some of these hotter biotech and technology issues, some come with a full warrant. And so guys like us, hedge funds, and other institutional investors subscribe to the IPO at $10, which we've been doing lately in our Accelerate Arbitrage Fund. But that game of subscribing in IPOs is becoming more and more challenging because each one is typically 5 to 10 times oversubscribed, meaning if there's a $200 million SPAC IPO, say tomorrow, demand orders from institutional investors could be as high as $1 billion to $2 billion. So orders are really getting cut back these days. But that kind of goes in and out. If we go back to the summer, SPAC IPOs were very hot in summer 2020, and our allocations were getting notched back significantly. Then October, November, we could get all filled on all of our IPO subscriptions. 80% of SPAC IPOs are trading below $10 per share, which I was looking at the ArcLight deal today, and that was actually one that I flagged in late September. It was trading at $9.96 per unit on IPO day of September 23rd. And that one came with half a warrant. And then I checked the units this morning. They're trading at $25 per unit based off this Proterra deal. And we are long those units, so shares plus warrants in our Accelerate Arbitrage Fund. So that's one that, it's worthwhile paying attention to these IPOs because that's typically when we buy. We like to own the units, which gives you the shares plus the warrants. So at IPOs, they raise a bunch of capital, call it $200 million, which goes into trust. And this trust account is invested in low-risk, short-term U.S. Treasury bills, basically the safest asset you could have. And the SPAC sponsor is not allowed to touch the IPO capital. Where they get funds to pay legal fees, banker fees, working capital for the SPAC is they typically do a private placement for warrant, a value of generally 2 to 3% of the IPO proceeds. So say on a $200 million SPAC IPO, the SPAC sponsor would put up, call it like $6 million, $10 million in private placement warrants to fund all the SPAC expenses. And the key reason why SPACs are so unique and what makes them a really interesting asset class from our perspective is the risk-reward dynamic. Chris and Mitch, you guys highlighted the so-called SPAC pop that we pay attention to. At post-deal announcement, many of these shares have been rallying significantly, whether it be the Churchill Capital deal recently announced, or rumored, I should say, the ArcLight Clean Proterra deal this morning, and so on and so on. You're seeing them rally 50, 100% in certain cases. But the most important aspect is that a SPAC, a sponsor, raises IPO proceeds at $10 per share, and they have a fixed term in which to do a business combination, typically 2 years. And if they don't get deal done within those 2 years, they liquidate and basically pay you back $10 plus accrued interest. And so really reducing your downside risk. In addition, say they do announce a deal and it's a dud, you don't like it, and they do give you the opportunity to redeem at $10 per share plus accrued interest. So it's a trade that I consider heads we win, tails we win big, because in the worst case scenario, we're buying at $10, we get that $10 back plus accrued interest, treasury bills. And in the case when they announce a deal and it's still a dud and we redeem, those warrants have a lot of value in most cases. Then in the tails we win big scenario, some of these shares are going up 50, 100%, sometimes even north of 200%. So it is fairly lucrative. We get to earn T-bill returns with equity-like upside and T-bill-like risk. So that's why we like it. I just got to caution listeners not to get too excited about it because a lot of these new issues are trading up pretty significantly. One that we actually did get a small allocation to in the recent IPO was SVF Investment, which is the SoftBank Vision Fund. Back IPO raised $525 million on Friday. That was a super hot deal, massively oversubscribed. So pretty lucky to get an allocation. However, this morning it's trading at $13, so 30% premium to cash for those units. So, I mean, at that point, the risk reward is pretty significantly different than buying these at $10. So just a word of caution with respect to trading these things because it requires a lot of due diligence and a lot of, being careful out there.